Welcome to today's video. We had a very strong market rally today. Bonds fell. That's counter to our investment thesis. Something I think everyone needs to be in consideration of, and certainly before watching these videos or making any investment decision, is your time horizon. We'll share our time horizon. We're longer term investors. We're not necessarily trading for tomorrow. We're trading for the next several weeks and several months. So things we talk about on this video are keeping that kind of timeline in mind. Today we heard from Fed member and board member Waller, and he brought up something we've talked a whole lot about, the neutral rate. Getting to neutral rate as quickly as possible, he said, wanting to front load that, 50 basis point hikes with the next 3 meetings. That would be, he said, the months, May, June, and July. That would get us close to the neutral rate, not all the way there, but close. Now, what's the significance of the neutral rate? Well, it's the rate we tend to chill at when the economy is strong and inflation's low. Waller kind of flirted with the idea of going above the neutral rate. Why would we go above the neutral rate? Well, the economy is strong, like other times that we are at the neutral rate, but inflation is high versus inflation not being high when we are at the neutral rate. So, in order to get inflation down, which is the Fed's #1 goal, because it's impacting the lowest class the most, and I can say that with certainty, because last quarter we saw 1.2 or last month rather, March, we saw 1.2 month-on-month inflation, 0.4% wage growth. Wages seem to be stagnating. Inflation, many claim, is peaking, likely to still remain elevated regardless, even if that is true. So we've got that dynamic. That's a 0.8% real wage loss, which if you annualize is quite strong. So sure, inflation might be peaking, but if it stays at this level and wages either stay at the same level of growth or don't continue to go up, well, you're going to have a quite significant annualized wage decrease, which again is something the Fed does not want. It goes against both of their mandates essentially. So they need to get above the neutral rate. And guess what? The last time we were above the neutral rate was before the 07-08 recession and crisis. Now, sure, there may be a change in dynamic around where rates are supposed to be. There's clearly a lot of demand for our bonds, etc. Maybe we are in a lower interest rate paradigm. However, it seems like the clear message is from the Fed, we have to get above the neutral rate. That's just the way it is, because if we don't, we're going to have even bigger problems on our hands. We can't let this gluttony, one of the 7 deadly sins or whatever, gluttony occur, or one of the 10 commandments, although I don't think it's one of the 10 commandments. Anyways, we all know what happened in 07-08. Obviously something happened there. More importantly, more relevant and closer to today, in the same kind of interest rate paradigm, I would argue, 2018 was the last time we got to the neutral rate, 2.5% or thereabouts. When we started heading towards the neutral rate, the market had a quite steep and strong drawdown. It did happen. So that's kind of our closest comp, I would say. And the Fed had to reverse that because it was not acceptable. And that's where the question becomes. Can we keep interest rates super low? Do we only need to do a little bit to get inflation down? Are we going to hit a recession and then there's going to be demand for bonds? That's where the unknowns are. And who knows? That might happen after. Maybe we get to a certain level and we come down. That's possible. I can see those arguments. However, there's a lot of unknowns there. I can't make any certain claims about that. I think we heard that from Jamie Dimon on the earnings call today, JP Morgan earnings call. My plan is the same. Today's move is not going to impact it. Actually, what will impact it is hearing from the Fed, and the Fed further reinforced, in my opinion, what I was under the impression was the truth and was going to happen, which is that we're getting to the neutral rate, and now I have slightly higher conviction in the unknown, or more unknown, I would say, whatever, getting beyond the neutral rate. So we'll have to see what happens. Market rally, as we said, we have positions that we are long, and we have positions that are directly in the line of fire. Go read the report and hear more about our favorite one, or one of our favorite ones. Jumia, we've talked many times about it on this channel. Editas talked many times about it on this channel. I have not sold these positions. So we're holding, and we're going to keep holding. We've got our things that we like. We're really just focusing on fundamentals. Excuse me. And we think these companies can grow way faster than the 10-year rate. So we're not really concerned about that. They are in the position to grow at tremendous rates. And we think they're priced too cheaply. So they're pricing less than the growth. So that's already better than the 10-year rate. So that is our assumption on those companies. But there are companies that are quite expensive and haven't adjusted and compete more directly with 10-year bonds for investor capital. So the bonds might get it. That's just the way it is. So that's today's video. And until next time, peace out.